right, everybody. In this episode, we're going to be talking about ETFs, exchange traded funds. What are they? We're going to discuss what sort of ETFs we can find in the market, how to buy and sell them, and best of all, how to profit. So if you stay until the end, I will assure you that you should have enough knowledge to be able to trade them and start making a consistent profit as time goes by. Welcome to Scotch and Stocks. This is for the boys that have complained about this, so here you go. Slide to smile, baby. All right. Right. Hopefully this makes me look a little bit better. By the way, I want to thank Cito for asking that question in the comments below. If you have any other questions, I'll make some videos about it. So leave your questions down below. So first of all, the question that we came here to answer is, what's an ETF? An ETF is an exchange traded fund. Now I'm going to put the description up here, and this is the description that I found in Investopedia. Investopedia is the best place to look for answers, anything investing, anything related. An ETFs is pretty much a basket of different assets that mimic something that the ETFs claims to do. So for example, if we have a basket of, let's say, the top 500 companies, which is the S&P 500. If we're looking to mimic that, we would follow ETFs such as VOO tends to be that one, right? The one that allows you to mimic the S&P 500, and that's what it does, right? Investing in one stock can be extremely risky. And if you don't want to handle that risk, or you particularly don't want to take that risk in investing in just one company that could go bankrupt, you go into ETFs. Why? Because ETFs give you a very diversified pool of assets that you can just buy as a single stock and keep in your portfolio, and you don't have to worry about making any changes, because usually the company that funds that ETF will make the changes for you. They do tend to charge a fee, but those fees tends to be small depending on what sort of ETF you're looking at, right? For long-term investing, they're really important because they allow you to just put your money and let it sit for a long time. And as long as the economy is doing well, your money does well. If you go for an investment in SPY or VOO, which tend to mimic, the top 500 companies in America. Now we have many different types of ETFs. We have ETFs that go with companies. You have currency ETFs that pretty much hold different currencies within it. You have industry ETFs. Those tend to be a little bit more aggressive in your investment way, just because they tend to follow how one industry performs. So for example, if you want to invest in electric vehicles, but you don't know which company you want to invest in, it's almost like putting your money in a bunch of different electric vehicle companies and hoping that the industry altogether does better. Similar, you can do that with real estate, you can do that with utilities, you can do that with commodities, you can do that with all that stuff. So ETFs just tends to be an investment tool that allows you to just grab a bigger basket of products. By the way, this video is sponsored by Scotch and Stocks. Scotch and Stocks is a show that me and my father do. We open up a bottle of whiskey and we talk about the market, we talk about investing, we talk about everything related to money. How do you buy ETFs? Buying ETFs is actually quite simple. It's just like buying a company. So if you already have access to a broker, by the way, all the brokers are down below, so just click on the link and make your account and get started. But I will show how to do it in eToro. And in eToro is very simple, right? In eToro, what you have to do is put money in. And after you have that money in, you can just look for the ETF that you're looking for and just click buy. Make sure you're not buying at a leveraged position. Make your purchase, leave it for a long time, and just see how it performs as time goes by. Now, some of the ETFs that I would recommend in investing for beginner investors, I would recommend looking at SPY VOO. Right? Those are the ones that will give you the best asset pick, and they're pretty safe, right? Obviously, they still do hold risk. If the economy downturns, we could definitely see a downfall in these investments, but they tend to be pretty solid assets, right? And if you hold them long term, as long as the American economy in this case is doing well, you should have a positive return in the coming years. These funds have averaged anywhere from 10 to 13% returns yearly, so that's what you should be expecting. Some years you're gonna maybe see it down, some years you're gonna see it even higher than those, but that's what the average has been in the past 10 years, which past returns do not ensure future returns, but it's a good way to look at it and maybe start expecting something in those lines. SPY and VOO tend to look at the top 500 companies in the United States, which means that usually by market cap, and they tend to place those positions depend on how big the company is in relation to the others. So you will see positions like Apple being massive parts of the ETF just because they're the bigger companies at the moment. Then you have QQQ. QQQ looks at the top 100 companies of the Nasdaq, right? So they tend to be technological companies that are, they're pretty big in terms of market size. That any money that you put into this ETFs, they'll grab a small portion of that money and it'll go into different companies, which is a good way of investing, just because it allows you to be diversified. You have the DIA, right? DIA is another ETF. This looks at the top 30 industrial companies of the United States, and this is mostly in the United States just because they tend to be more prevalent in the United States, and the growth of the United States tends to be very aggressive. Then you have sector ETFs, and sector ETFs can be, there are many different sectors as I'll show. Like the S&P, even the S&P 500 is divided into, and that should allow you to maybe make decisions and start looking like a little bit, start digging a little bit deeper, right? By the way, this is not financial advice, and do not listen to a random guy on the internet, just like me. I'm a random guy on the internet alert, But this is a place to start. If you're looking to just put your money and leave it for a long time, this could actually allow you to create a passive way of creating wealth, because that money will grow and grow and grow, and instead of holding cash which doesn't grow at all, you actually hold an asset that's people are working towards making it bigger and better. It's a tricky bit, right? Because the thing is this, you can always lose money when you're investing, and that's part of the journey, right? Like it's very difficult for you to just like put some money and then suddenly be in the positives. I mean, it can happen, but it's not the norm, just because timing the market, it's not the best thing in the world, right? There's a saying in finance that time in the market always beats timing the market, right? So as long as you can stay within the market, it's actually a beneficial thing for your money. So yeah, just make sure you do your own due diligence and make sure this is just the beginning, a place to start. If you have any questions, put them down below. I'll gladly answer them. Yeah, I mean, the earlier you start, the more your money can compound. And that's something very important. Compound interest is very, very important. Because the thing is just like, if you're growing your money at 10%, let's say, let's average down at 13% a year. If let's say you put $500 every month into a savings account at a 13% yearly return, after 10 years, you're going to have this amount. After 20 years, you're going to have this amount. And then after 30 years, you're going to have this amount. And the amount that you've totally invested after the 30 years is going to be this, right? So get started, and hopefully get started quick, because the earlier you start, the more money you'll make in the long run. Happy investing, everybody.